When we look at a stock price, our first instinct is always to ask, okay, where's it going next? But what if that's not even the best question? What if we should be asking, what story is today's price already telling us? And that, right there, is where this really powerful tool called a reverse DCF comes into play. It's all about learning how to read that story. This quote just nails it, doesn't it? It perfectly captures the shift in thinking we're gonna explore. So instead of trying to be some kind of fortune teller, we're gonna become more like a detective, decoding the expectations that are already baked right into the market price.
So, to really get why this new approach is so useful, first we've got to look at the traditional way investors try to value a company. I call this the predictor's problem, and, well, you'll see pretty quickly why it can be so incredibly difficult.
This is the classic challenge, right? We can spend countless hours building these super complex models, trying to guess next year's earnings and the year after that. But at its core, this is a game of pure forecasting. And let's be honest, the future is notoriously unpredictable.
This is the textbook method, the standard DCF. It requires us to be the oracle. We have to predict a company's future profits, its cash generation, and then use a discount rate to figure out what all that future money is actually worth in our hands today. The entire model, the whole thing, hinges on the quality of our forecast. No pressure, right? And this is the fundamental and frankly very fragile question that a standard DCF forces us to answer. The final number, that valuation, is only as good as our ability to see into the future. It just puts all the pressure on us to be right.
But what if that's the wrong question entirely? Seriously, instead of putting all the pressure on our own predictions, let's just flip the problem on its head. Let's start with the one piece of data we know for sure: today's stock price.
Okay, so this is the flip in action. A standard DCF makes your forecast the input to find some target price. But a reverse DCF, it makes the current stock price the input. It then works backward to reveal the forecast the market must believe for that price to make any sense. It's a complete reversal of the whole process.
So, yeah, we are literally working backward. We take the market's answer, the stock price, and we solve for the hidden question. What level of growth, what kind of performance is the market collectively assuming to arrive at this exact valuation?
And this creates such a powerful mental shift. The burden of predicting the future is just lifted. Your new job isn't to guess what's going to happen, but to analyze the future that's already implied by the price and then decide if that future is even plausible.
Okay, this all sounds great in theory, but how do we actually uncover the market story? Let's just walk through the basic mechanics. I think you'll see it's much more straightforward than you might think.
It really just boils down to 3 core steps. You start with the company's total value, you set some reasonable bookends for your financial assumptions, and then you just solve for that one missing variable, the implied growth rate.
Let's ground this with a super simple example. Imagine a company with an enterprise value, that's its total worth, of, say, £10 billion. It's currently generating about £400 million in free cash flow. We'll use a discount rate of 9% and assume it grows at 2% forever after our main forecast period. With these inputs, we've got everything we need.
So, what's the missing piece? Well, to justify that £10 billion price tag, the math tells us this company's free cash flow needs to grow at an average of 16 to 18% per year for the next 5 years. That is the market's implied story. So we have our number, 16 to 18% growth. But a number alone is totally useless. Now comes the most important part of the entire process, judgment. We have to ask ourselves, is the story believable? Is this some kind of fairy tale or is it actually grounded in reality? This is the key question the entire exercise leads to. So forget trying to predict if the stock will go up or down. Just focus on this. Based on everything you know about this company, its industry, its history, is 18% annual growth for 5 years a believable outcome?
Now, to answer that, you don't have to guess. You can use a reality checklist to stress test the story. For example, is the total addressable market, the TAM, actually big enough to support that kind of growth? Has any competitor ever grown this fast? Does it require the company to suddenly accelerate far beyond its historical pace? These questions move the analysis from a spreadsheet into a real-world business discussion.
And that's the beauty of it. You're not looking for a single perfect number. You're using that implied growth rate to force an evidence-based conversation with yourself about the company's real prospects.
All right, let's bring this all together. By flipping the question, analyzing expectations, and then stress testing the story, the reverse DCF becomes more than just a calculation. It becomes your new thinking tool for evaluating any investment. Here is the final takeaway, boiled down to a super simple framework. If the market story is heroic, I mean it's demanding phenomenal, world-beating growth, but the business reality looks pretty average, well then you have a clear signal. The price is likely stretched because it's priced for a perfect future that may never arrive.
And that's really the ultimate question this tool empowers you to answer. You've learned how to read the expectations that are embedded in the price, so the only thing left to decide is whether the company in the real world has what it takes to actually beat that story.